Internal Revenue Service IRS tax news. Looking ahead, how the American Rescue Plan affects 2021 taxes, part 2. So this is part 2 of the 2021 taxes, or the impact on it from the American Rescue Plan. You might be asking, why am I thinking about 2021 taxes when I don't actually file the tax return for the 2021 taxes until like April 15th of 2022? How does that impact me at this point in time? There's a few answers to that. One is that the changes for 2021 could actually have a cash flow impact on you at this point in time, due to the fact that some of the strategies that the IRS seems to be taking in order to stimulate the economy are these prepayment type of things. So in other words, that you might have cash flow related to some kind of prepayment component of some of the laws that are going to be changed for 2021, even though you don't file the tax return until 2022. And two, you also want to basically make sure that you have your estimated tax payments and your tax planning set up correctly. And for people that are in the higher income areas, obviously you need to do tax planning all the time. And people that are in the lower income areas, then tax planning is still going to be necessary, because you're going to be bouncing around more than usual. In other words, tax planning is usually based on the prior year, and it's a lot easier to do if there's stability over time. Now, in this case, there is no stability for many people over time. There's a lot of uncertainty about people's jobs that were bouncing around in the prior year and continuing to do so in the current year. And there is also no stability with regards to the tax law. Many of these laws are one-time things that are going in place. They're going to go away, and therefore your withholdings become much more confusing in terms of what withholding should be. So you want to make sure that you have the planning set up so you don't have any kind of unknown penalties or not taking advantage of any kind of special benefits that are currently going in place due to the changes in the laws that are rapidly occurring as we continue to go on here in 2021. So we have the COVID tax tip 2021-79, June 3rd, 2021. This is the second of two tax tips providing an overview of ways the American Rescue Plan may affect some people's 2021 taxes. Part 1 is available on IRS.gov. So if you want to look at part 1, we went through that earlier as well. This is part 2. So changes expanding the EITC, the Earned Income Tax Credit, in other words, for 2021 and beyond. So the new law changes expand the Earned Income Tax Credit, the EITC, for 2021 and future years. These changes include more workers and working families who also have investment income can get the credit. So they've changed it so more people possibly are able to get the credit. Starting in 2021, the amount of investment income they can receive and still be eligible for the Earned Income Tax Credit increased to $10,000. Now you might ask, well, why is that relevant? Note that the Earned Income Tax Credit is quite complicated. It's going to be a credit that's generally on lower income individuals, but in order to incentivize works, it actually goes up as your income goes up. Most of these types of credits will go down as your income goes up, which kind of makes sense because the idea is that you wouldn't need the credit at that point in time, but that works as a disincentive for you to work. It actually locks people out of the workforce, which is really not good. So the Earned Income Tax Credit is trying to give incentive for work, so it doesn't just remove the benefit when people start working, because working is beneficial just in and of itself, but then it'll go down after some point in time. It's also going to be influenced by the children, so 0 to 3 children, so the qualifications can be a little bit complex, and then once you qualify, it's kind of complex to know what the actual amount of the credit is. Now, one of the restrictions they had was the idea of the investment income. That's like dividends and interest income. And the idea there, you might say, well, what? It's just another form of income. Why don't you just put that into the income threshold? But it's not really. It's passive income. It's not really like earned income. And the idea would be that if you have a lot of passive income, like dividends and interest, that would mean that you have a lot of assets, right? You got some investments in place that either savings accounts or kind of stocks that you're making money on. And if you're making $10,000 of investment income, it doesn't seem like you may not really need a credit that's going to be designed to help people that are in times of low income, possibly. So that's the idea of this credit. So they've actually increased it. So $10,000 of investment income, if you think about how much money you must have to get interest of $10,000, given the interest rates or the returns, then you can kind of think about, well, how much assets must they have then in order to get that return and whatnot, and should they qualify for the credit? Okay, so married but separate spouses who do not file a joint return may qualify to claim the earned income tax credit. So once again, married but separated spouses who do not file a joint return. This is often a complex situation for many families that they're split up, and the question often comes up to, well, what's the filing status? Because normally, if you file married, if you are married, you can only file married or married filing separate, unless there's kind of some separation or some kind of special rule in terms of what does it mean to file married filing joint or married filing separate versus single or head of household. So that can be a kind of a complex area. So they qualify if they live with their qualifying child for more than half of the year and either do not have the same principal place of abode as the other spouse for at least last 6 months of tax year for which the EITC is being claimed, or are legally separated according to their state law under a written separation agreement or a decree of separate maintenance, and do not live in the same household as their spouse at the end of the tax year for which the EITC is being claimed. So note, when you think about a separation, you're saying, okay, now they're separated. Usually that falls under state law, and you have to go by the state law. But the IRS is basically saying, well, for this purposes, you might be able to qualify for this first item, even if you don't qualify for not being married under basically the state law and whatnot. So again, you can go into that in more detail if that's an issue for you, and if you would benefit from filing, say, head of household, you feel like you're separated even though not legally divorced, or so on and so on. So expanded child tax credit for 2021 only. The American Rescue Plan made several notable but temporary changes to the child tax credit, including increasing the amount of the credit, making it available for qualifying children who turn age 17 in 2021, making it fully refundable for most taxpayers, and allowing many taxpayers to receive half of the estimated 2021 credit in advance. So this is a huge change that they've been talking about a lot. So let's look at it one more time and look at these changes. The American Rescue Plan made several notable but temporary changes to the child tax credit. So they're saying they're temporary here, meaning they didn't write them into the law at this point in time, that they're going to be extending, more than the year into the future. So you can't really depend on them. I'm still skeptical that they won't basically be forced to keep them after that point in time, because it's hard to take out a credit once it's been put in place. But it's not currently in law that it would be in place, and the current plan is that it would expire and so on, as my interpretation of it. But what do we have then? We have the increase in the amount of the credits. The amount of the credit has now gone up. Now, this credit normally would be something that you would get when you file your tax return in 2022 for 2021. So you'd have that increase on the child tax credit, but you might even get some of it again in 2021 rather than when you file in 2022. So making it available for qualifying children who turn age 17 in 2021. So I think that's a bit of an extension on the age limit as well, making it fully refundable. That's a huge component, meaning that means that the whole thing now is something that you could get even if you don't owe any tax liability. So even if you don't have any tax liability, so that makes it more of like a benefit program as opposed to like a refund type of program. So it's not really a tax at that point if it's a refundable thing. It's more like a benefit program, allowing many taxpayers to receive half of the estimated 2021 credit in advance. So that's one of the reasons I think they made it refundable, because it makes it a lot more easy for them to predict what it will be. And it looks like they're just going to take half of the amount that they calculate, and they're going to have to do that based on prior year returns. So based on your 2019 or 2020 return, they determine what your credit would be in 2021. Considering it's all refundable, then they can basically try to give half of it out, I guess, in just checks. That it looks like they're just going to send out checks during 2021, and then you'll have to basically reconcile what they gave you to the actual credit at the end of the year or when you file in 2022. So similar to kind of like the earned income tax credit kind of system where they tried to give the advance payment and then use the recovery rebate credit after that. It's also similar to the healthcare marketplace type of system where they lower your premium but have this advanced kind of payment. So they're really doing this advanced thing a lot. That's the the big tool that they're using to get the money out sooner. It's kind of confusing, actually, but it's a way to get the money out sooner. So taxpayers who have qualified children under the age of 18 at the end of 2021 can now get the full credit if they have little or no income from a job, business, or other source. So prior to 2021, the credit was worth up to $2,000 per child, with the refundable portion limited to $1,400. So that was the prior rule. So you basically, most people probably have an idea of that number, right? $2,000 for the child tax credit, but then the refundable portion was lower. That would be if your tax liability was zero, you're not going to get the refundable amount that would bring you below zero was only $1,400 per child. The new law increases the credit to as much as $3,000 per child ages 6 through 17 at the end of 2021 and $3,600 per child ages 5 and under at the end of 2021. So they got this two-tier type of thing, 5 and under, and then 6 to 17. So for taxpayers who have their main homes in the United States for more than half of the tax year and bona fide resident of Puerto Rico, the credit is fully refundable. Now it's refundable, the whole thing. And the $1,400 limit does not apply. So they've increased the credit quite substantially here, and they made the whole thing refundable. So then the maximum credit is available to taxpayers with a modified adjusted gross income. Now, there's still an income limitation, so that could cap, and that's just like the recovery rebate credit. That's one of the things that is going to cause confusion when they do these prepayment things. So you're always going to have this income limit kind of question here. So $75,000 or less for single filers and married persons filing a separate returns, $112,500 or less for head of households, and $150,000 or less for married couples filing a joint return and qualifying widows and widowers. So above these income thresholds, the excess amount over the original $2,000 credit, either $1,000 or $1,600 per child, reduces by $50 for every $1,000 in additional modified adjusted gross income. So that gets confusing. Now you got that phase out thing. So once you go over that threshold on the income limit, then it's going to be confusing. It's going to be harder to estimate. It's going to be a lot more useful to calculate if you have software, and it's going to be a lot more difficult for them to estimate based on the prior year tax return, and it could cause kind of differences that you'll have to reconcile most likely when you file the 2022 tax return if you have some kind of income limitation that could be applying. So the original $2,000 credit continues to be reduced by $50 for every $1,000 that the modified AGI, adjusted gross income, is more than $200,000, $400,000 for married couples filing a joint return. And then we have the advanced child tax credit payments. So from July 15th through December 2021, Treasury and the IRS will advance one half of the estimated 2021 child tax credit in monthly payments to eligible taxpayers. So they're going to take the credit that you would have gotten up top when filing the 2021 taxes in 2021 too, and it looks like they're going to just divide it by 2, take half of it, and then try to figure out how much could be sent out monthly for July through December, and then just send out basically checks, just monthly checks from the IRS, it looks like, apparently. So eligible taxpayers are taxpayers who have a home in the United States for more than half the year. This means the 50 states and the District of Columbia, U.S. military personnel stationed outside the United States, and extended active duty are considered to have a main home in the United States. So the monthly advance payment will be estimated from their 2020 tax return or their 2019 tax return if 2020 information is not available. So it's just like the recovery rebate credit. They're going to have to figure out your qualifications based on the prior year, which should make it easier now that they made it all refundable, although you still have that income cap, and you also have a situation where if you have a new dependent in the current year, a baby or something like, or you adopt, and in 2020, they wouldn't know about it because it wasn't on. If you did that in 2021, they wouldn't know about it because it wasn't on the 2020 tax return. So there's still some kind of changes that, discrepancies that will take place, and they'll have to kind of reconcile when filing the 2022 taxes, most likely. But let's read on here. Advance payments will not be reduced or offset for overdue taxes or other federal or state debts that taxpayers or their spouses owe. So it looks like they're not, normally if you have a refund the IRS will take that refund, and if you owe taxes to like the state or some other debts that the IRS is working with, they will take your refund and pay it to them first. But it looks like here they're not going to do that. They're actually going to give it to you, before giving it to the states or something. So advance payments will not be reduced or offset for overdue taxes or other federal or state debts that taxpayers or their spouses owe. So taxpayers will claim the remaining child tax credit based on their 2021 information when they file their 2021 income taxes. So you'll get the difference. It looks like when I first was hearing about this, I was a little concerned because when they give the advance payment, then clearly people will still be depending on the payment that they're going to get when they file the return. So because when they file the return, they've gotten used to getting, the $2,000 or whatever benefit at that time. But it looks like what they did is they increased the credit substantially, and then they're only going to give out half of it in the advance payment. And so you're still going to get a tax benefit. When you file the tax return, you'll get the other half, it looks like, when you file the tax return in 2022. But you still want to kind of keep an idea of what the advance payment and what the other amount was. I still don't see what they've mentioned a couple times in the past, what they might do about a situation where you had a child or adopted in 2021, whether you can get some kind of advance payment based on them, even though the tax, they don't know about that yet. They're not going to know about it because they weren't on the tax return in 2020. I haven't seen any new information about that situation yet, but I have seen some alluding to it. So they might give more information about that in the future.